Thank you. Good afternoon and welcome to today's webinar. Again, my name is John Belos and I am in the product marketing group for the Community Financial Solution Portfolio at ACI Worldwide. Thank you for attending our conversation. With us today we have Ron Sheblin. Ron is a Senior Analyst at the IT Group, where he focuses on helping financial institutions improve the effectiveness and efficiency of their marketing efforts. His research topics include online sales and marketing, marketing analytics, personal financial management, and consumer behavior. I think we have an interesting topic for Ron today, the impact of mobile on the future of retail banking. Now, this is a topic that's on everyone's radar, regardless of the size of your institution or where you're at with your mobile strategy. And as Ron will discuss, an interesting element of mobile is the changing and evolving needs of the consumer and technological information that addresses those needs. So with that, I'll turn it over to Ron.
Thanks, John. I don't know if you, John, and the attendees on the line have been following what's been going on in the world of financial services over the past couple of years, but it truly is amazing how technology has changed how the financial institutions do business, and in particular, how technology has transformed the marketing of retail financial services. I can't think of a better example of the impact of technology on how marketing's been done than what's happened at this credit union, and their ability to use new technologies to change their marketing. I'm just joking, of course. There have been plenty of changes in how financial services have changed their operations, customer service, and marketing. But we're going to see a lot more in the next couple of years, obviously, with the advent of mobile technologies. But the key thing that I really want to get across today is not just telling everybody that there'll be lots of changes, but to explain the impact of those changes on the industry. And in particular, how mobile innovation is creating a new phase of competition in financial services. It's not simply about providing new services or new marketing opportunities. It's really changing the nature of the competition for financial services, and especially in the retail financial services area, and changing the basis by which financial institutions like banks and credit unions compete with each other. To kind of play out my theme here, what I'm going to do is pose and address three questions today. The first thing I'm going to do is talk a little bit about why we're going to see this change now. It's not simply enough that we're seeing technology change. There's another big driver, and it's called economic imperative. I'll talk a little bit about why this is happening today. We can then get to the next part of the presentation and talk a little bit more about how mobile is going to change financial institutions. And I'll look into the future a little bit and talk specifically about how mobile is going to change what financial institutions market, where they market, and when they market their products and services. And then we'll wrap up kind of bringing this all together and talk a little bit more about what this new phase of competition really looks like. So as I mentioned, we've seen plenty of technology change over the past 10, 15 years with the advent of the internet technologies and so forth and social media. But if you really kind of look at the industry, there has not been broad transformation of the industry. Most of the major players are still in place. Even more importantly, consumers still pretty much buy the same products, checking accounts, credit cards, and so forth, that they've been buying for the past 40, 50 years and applying for. And I think that we haven't seen that change because there's been a missing element in the equation for why industries change. And that missing element is economic imperative. If we look at some data from the Federal Reserve Bank and this chart actually starts at 1998, but you can actually go back to 1993 and find that in about a 15-year period, the industry's return on equity hovered in a fairly narrow range from about 13 to 15% before falling off the cliff in 2007, 2008 timeframe. And my point is that without strong economic imperative, institutions and companies in an industry are not very likely to change. 10 years ago, I did some research around customer loyalty and tried to identify some of the drivers of customer loyalty and went out to tell my bank and credit union clients about the findings. And I really was met with pretty much not particular lot of enthusiasm because the response was pretty much strong. We're doing real well. Why would we change? Well, now things aren't as good as they were 10, 15 years ago, and there's much more of a imperative for financial institutions to change. And although profit levels have rebounded from the bottom of 2008, 2009, for the most part, return on equity in the industry has not risen back to its historical levels, only at about 8%. And it kind of begs the question, well, what will it take to bridge this gap? The Boston Consulting Group has done some analysis, and they have some ideas and theories as to what banks and credit unions can do to help bridge this gap. They believe that the industry can put 3 or 4 percentage points of ROE back onto the metric through cost reduction. I think this is going to be an incredibly difficult challenge for the industry, not just let alone individual institutions, because what we're talking about here is literally taking $70 to $80 billion of cost out of the cost structure of the financial services industry. And short of eliminating checks altogether, eliminating the branch network altogether, it's going to be an awful challenge to take this level of cost out, especially in an environment where we're adding costs by adding new technologies, new channels, and trying to develop new products and services. BCG also believes that the industry could put a couple more points, 2 to 4 percentage points on the ROE metric through pricing and growth. And this, too, is going to be a major challenge. The regulatory environment over the past couple of years has been pretty difficult for banks. And instead of giving more flexibility from a pricing perspective, it's really done the opposite. And as a result, what the industry has seen is almost a 20% decline in deposit account service charges, mostly through the reduction in overdraft fees, as a result of regulations which have limited their ability to price overdraft fees the way they want to. But we've also seen this limitation in terms of interest rate, lack of flexibility in interest rates on credit cards, and other host of regulatory moves that have limited the banks and credit unions and card issuers' ability to price and optimize their price. From a growth perspective, things are difficult as well. I think the bottom line on this is that what we're really looking at in the industry is more than just the ability to cut costs to get profitability. It's a challenge to generate revenues. And for me, I think it all gets summed up in what I would think of as the non-interest income challenge. The 35 largest banks in the U.S. on average generate about 2.6% of their total assets in non-interest income. And most of them will say that that's nowhere near where they want it to be. I think many of them would like to see that number closer to 5%. But yet the other 7,000 financial institutions in this country are barely at half the level that the top 35 banks are. And this is the major challenge, I think, in the industry right now is how do we generate revenue profitably to fill this gap and address the regulatory environment that has limited our ability to optimize price, and in an environment where we've seen low growth in terms of the demand for core traditional financial products. So this is why we're going to see change now. It's not simply that there's new technologies on the horizon. It's that there's a strong economic imperative to change and find new sources of revenue, new sources of income, and new ways of increasing profitability. So let's look out a little bit and talk about what these changes are. I'd like to share this with you because, well, I have seen the future, and I'd like to share that with you today. How is it that I have seen the future? Well, that's my job. That's what I do. I'm an industry analyst. Been doing this for about 15 years now. Actually, since we can't meet face-to-face, I thought maybe you'd like to see a picture of me at work. Yeah, that's me. I sit there in my office with my hat on and my crystal ball. And when I look at my crystal ball, I see a couple is coming down the pike that is going to be caused by the development of mobile technologies. 3 things in particular is how mobile changes FIs. The first is in changing what financial institutions market and sell. I'll tell you a little bit about the development of what I would call neo-checking accounts, new types of accounts that will not necessarily replace the traditional checking account, but will supplement and create new types of products for financial institutions to market. The second big change is not just in what financial institutions market, but where they market. And with the rise of mobile technologies, we also see the rise of mobile apps and how mobile apps will become a new marketing platform for financial institutions. The third piece we'll talk about is when. There have been traditional moments of opportunity that financial institutions have looked for in terms of reaching their customers with marketing messages. And with the advent of mobile technologies, it's creating new moments of opportunity, specifically around mobile shopping. And we'll get into that as well. So let's deal with the first, what financial institutions market. Over the past couple of years, we've seen a growth in interest in prepaid debit cards. And traditionally and historically, many bankers within the industry have thought of prepaid debit cards as a product for the underclass or the underserved. But what's really happening is that many more consumers are turning to prepaid debit cards because they're looking for alternatives to the traditional checking account. And it's not just the underserved, underprivileged market. It's about more of the mainstream market. And what's happening is that we're seeing a new group, a new segment of consumers emerging that I think of as the debanked, not the unbanked or the underbanked. But these are mainstream consumers who willingly opt out of the traditional banking system. These are very highly educated consumers. It's not a particularly big segment today, probably less than 10% of the total market would be categorized as debanked consumers. But importantly, it's growing, and it's growing rapidly. And these are highly educated younger consumers who are looking at the market and saying, well, we've done the math, and checking accounts don't make any sense for me. Given the fees, given the fact that they recognize they'll probably overdraw on their account 1 or 2 times a year, they're looking for accounts that are better fit for their level of income. They're looking for accounts and products that better suit their needs from a spending perspective, and they're looking for help in managing their financial lives. And so they are unbanked, but only because they are willingly unbanked. They are looking for alternatives. And this is creating new opportunities for financial institutions and new entrants into the market to create new types of products and services. I think of them as neo-checking accounts. I mean, they're not traditionally checking accounts in that they issue a checkbook that consumers write on, but they're really spending accounts. Companies like Movin' Bank and Bank Simple and recently GoBank from Green Dot are issuing these types of accounts that give consumers the ability to manage their spending on a day-to-day basis, and they look somewhat like checking accounts, even though checks are practically not even existed in any of these types of accounts. There are a couple of things that characterize these new types of accounts. The first is that it's really a mobile-first design. And I know a lot of folks talk about designing first for mobile when it comes to interacting with consumers these days, and it's probably a little bit too far ahead of the curve to really be doing that for the vast majority of consumers. But for the consumers that are looking for these alternatives to the traditional checking account, it really is about designing first for mobile because they're looking to make better use of their mobile device, and specifically their smartphones and tablets, to be the primary interface between them and these accounts. They're still accessing the phone when they have problems. They're not particularly tied to the branch per se, but they're looking to use their mobile device as the primary device for interfacing with these accounts and with their providers. I think more importantly, though, because everybody will eventually catch up, or many institutions will catch up from a mobile banking perspective, but what's more important than just the mobile-first design is the fact that these neo-checking accounts provide a greater level of point-of-decision input and feedback. Whereas most traditional checking accounts today for most large financial institutions have some sort of personal financial management or PFM capability that's built into the online banking platform that consumers then have to go and access when they get home by using their PCs late at night when they're trying to look at their budgets or categorize expenses. These neo-checking accounts really integrate that PFM capability right at the point of decision or at the point of interaction or point of purchase. The third key differentiation is really in the structure of the account itself. I said before that I call these neo-checking accounts because I'm trying to not get too far away from the idea of the checking account that most people know and love. But these accounts really defy categorization because they blend prepaid debit and credit capabilities. And I think the Movin' Bank example is great because it's structured to allow a customer to grow with the account. And there's a certain set of features and capabilities that the account offers based on your cred score, which is sort of an alternative to the FICO score, that dictates the level of capabilities and services you get. And as your cred score improves, so do the level of features you get, and it grows with it. And what's truly different is that in the current environment, we're always trying to get customers to close out other accounts from other providers and open up new accounts, even with our own institutions. These neo-checking accounts are a much more fluid type of structure that blend these types of features and grow with the account, getting away from the rigor of having to have customers open and close accounts all the time. To give you an example from a pictorial perspective in terms of what Moving Bank is doing, and specifically to demonstrate the notion of input, point of decision, input, and feedback, even Moving Bank, which has this mobile-first design, still has a card that consumers can pay with. They can still swipe with a traditional-looking credit card or debit card, but when they do, the mobile app provides them with a digital receipt to let them know that they've got it, so we get away from the paper management. And they also provide some indication in terms of the spending level. So there's point of decision, point of purchase spend tracking that in this example gives the customer the ability to see, well, that they're in the red, they've over their budget. They don't need to go home later at night to do analysis with PFM. They're getting the feedback either right before they make the purchase or right after they make their purchase. This idea of incorporating mobile capabilities at the point of sale, at the point of decision, or really outside of the home itself is actually something that insurance companies have been doing for a while now with telematics. And this is an example of one of the insurance providers that you install this in your car and it tracks the mileage, the speed, and your driving conditions that helps dictate what you actually spend from an insurance perspective. It's an example of how mobile technology has changed the core product. And what's important from the insurer's perspective is that not only does this change the nature of the base insurance account, but gives the insurer new capabilities to supply new types of products and services like weather alerts or stolen car alerts and other types of add-on value-added features and services that could help them generate new revenues. So this is one of the first examples of how mobile changes financial services in terms of enabling FIs to create new types of products and services to diversify the revenue flow. But also importantly is not just in creating new types of products and services, but changing where financial institutions do their marketing today and how mobile apps will become a new marketing platform. Make no mistake about it, mobile apps are very important to a very wide range of players in many industries, not just financial institutions, but to the technology providers as well. To give you an example of how important apps are to a firm like Apple, I'm going to do something I probably shouldn't do. Apple shares with me a lot of their future marketing plans, and I'm not supposed to share that with you. But I thought, what the hell, you've been so nice to get on this webinar today, so I thought I'd share with you a future marketing campaign on part of Apple for one of their future releases of the iPhone. You should be looking for this in the next 6 to 12 months, I would guess. It's the Apple iPhone 30s. 30 lines of apps distributed across 2 physical devices connected by a Lightning connector, doubles as a smartphone and nunchucks, the ultimate in personal and data security. Just joking, of course. But clearly apps are important and very important to financial institutions and to consumers as well. This is a chart that shows the ranking of JP Morgan Chase's mobile app over the past 90 days or so. And not surprisingly, given the size of the institution, that they'd be right at the top of the list in terms of downloads within the financial category. But I wanted to show you this chart to show you that in the context of all of the apps in the App Store, and there's about 850,000 apps, that in the U.S., Chase's mobile app has been hovering in the top 100 to top 200 downloaded apps for the past 90 days. Those gray bars are the weekends, and for some reason people don't really download their bank apps or credit card apps on the weekends. But with 850,000 apps out there, and a lot of that activity occurring with game apps and entertainment apps and weather apps and so forth, the fact that one individual bank or one individual financial institution's mobile app could crack and be consistently in the top 200 apps downloaded over a 90-day period really demonstrates that consumers are definitely adopting mobile apps as a way of interacting and interfacing with their financial institutions. Beyond, though, simply doing business and with single institutions apps, I think there are some signs that show that the financial services apps and financial apps in general are becoming very important to consumers. There's a company called Flurry that tracks what they call apps loyalty. What they look at is the retention of an app over a 30, 60, and 90-day period. Because what happens with a lot of folks, you may know this from your own behavior, is that you get an app, you play around with it, you either like it or don't like it, and if you don't, you delete it off your phone or never use it again. But the other key measure to an app's loyalty is how often consumers use it on a weekly basis. And getting data directly from various apps providers, they're able to measure across a range of industries the consumer loyalty to various types of apps. And what they have found is that there are a series of apps like daily deals and retail apps, music, education, health, and fitness that consumers download. They don't use a particularly frequent amount of times on a weekly basis, and then don't actually keep for a very long period of time from a monthly or weekly basis. I guess what happens is the people go on, they expect to get a great deal or see something that's of value to them, don't see it, and kind of move on from those. There are other types of apps like travel and food and drink apps that don't get used very frequently, but that consumers keep on their apps probably because they see the value of these apps, but because they don't travel that much or don't eat out or drink that much, they don't use it that much on a frequent basis. There are a whole series of apps that consumers use a lot in a weekly basis. They just don't keep it very long. Streaming music, they might find that they don't get the music for free. They will download dating apps and use them very often in the first week or so after using it, find that they can't get a date and move on. But there are a series of apps that fall into this upper right-hand quadrant of apps that consumers keep on their devices and that they use on a frequent basis. Apps like communications and news, sports scores, and weather, not surprising given how often we want to check the scores of our favorite sports teams or the weather. But financial apps like budgeting and expense categorization apps barely but do creep into this upper quadrant of apps that are used on an above-average frequency basis and that consumers use on keep on their devices for an above-average period of time. So it's clear to me that the financial apps in the scheme of all the apps that are out there are important to consumers. And make no mistake about it, people are willing to pay to download these apps. Gartner has estimated that this year the number of apps, paid apps that people will download will grow at about 60% over last year and nearly triple in number by 2016. The problem, though, is that while consumers do show a willingness to pay to download apps, they don't show that in terms of financial services apps. To demonstrate this, if you look at some data from a company called Distimo, which tracks the apps market, they've estimated that almost 2,300 different game apps have cracked the top 25 best-selling apps from a paid download perspective. The next most popular category is the entertainment category, where only 350 apps have cracked the top 25, followed by photography and utilities. Now, I would have had to really stretch this graph out to show you all the categories in between utilities and finance. But of all the apps that are out there, only 30 financial apps have cracked the top 25. So consumers are not showing a willingness to pay for financial apps. And for me, that kind of begs the question, why? Why not? I'm sure you probably have some pretty good theories yourself, probably agree with me on some of these points, but I think there are three major reasons why consumers are not paying to download apps. And the first is that, well, for the most part, we're kind of used to getting everything for free. Financial institutions have been bundling services and products within the checking account structure for years. But that's beginning to change as the economics realities of the industry are changing, and financial institutions are beginning to unbundle a lot of these products and services and look for new ways to generate revenue. Second reason why I think consumers have not been paying for apps is that for those consumers that do pay for apps, who are usually younger consumers under the age of 30, if not under the age of 25, the reality is that financial apps just aren't important to them at this point in their life stage as things like games and entertainment. But there is a third aspect to it, and I think it's what's the most important to financial services firms right now, is that the other reason why consumers are not paying for apps is because they've not been marketed very well. There's a company called Canalys that also tracks the apps and mobile market. One of their senior analysts recently said that when they speak with apps developers, many are concerned about monetization or platform fragmentation, but the number one problem they face is getting their apps noticed. The reality is if you went to the App Store and looked at financial apps, you would see 6 pages of financial apps that begin with the letter A, just the letter A. I haven't even counted how many there are across the 26 letters of the alphabet. So the reality is that it's really tough for consumers to figure out what's exactly out there. But what's happening is that with the use and the importance of these apps, the apps become a new marketing platform. And it's more than just charging consumers for this. In fact, what Distimo has estimated is that the total revenue generated from apps these days, only 1 out of $4 comes from paid apps, paid download apps. 3/4 of the revenue comes from revenue that's generated through in-app purchases, and the vast majority of that comes from in-app purchases from free apps. So how well is a firm like J.P. Morgan Chase in the top 100 or 200 of apps downloaded on a weekly basis, daily basis? How well are they doing in generating revenue through their free apps? Not particularly well at all. I don't think they're focused on it. And I'm not just picking on Chase. Very few financial institutions are seeing any sort of revenue from that because they have not made this transition yet to seeing how they can use this as a new marketing platform. But that's not to say that there isn't money to be made there. One of the top revenue apps, generating apps in the financial services market is an app called Bob the Trader. In terms of the top grossing rank, it's pretty much up there over the past 90 days. And to put it in context, you can see that the blue lines there kind of go all over the place. The app has cracked the top 500 grossing apps a number of times over the past 90 days, have fallen down to the 1,000 to 2,000 mark in a number of weeks. But this demonstrates that we're talking here about a pool of 850,000 apps, and so there is the opportunity to be generating revenue. This particular app generates revenue through subscriptions, through value content, through advice to folks who are trading and looking to following the market. There is an opportunity, and this is a company that I would imagine few consumers on a general basis have any clue who they are other than frequent traders, show that demonstrates that there is an opportunity to generate revenue through apps, through effective marketing. By the way, just as an aside, if you've got kids in the 10 to 20-year-old range, you might remember Bob the Trader from his previous job as Bob the Builder. I'm not sure if you remember him or not. Talking about trading taglines, Bob's traded, "Can we build it? Yes, we can." For "Can we trade this sucker? Yes, we can." So we've looked at how mobile is going to change what financial institutions market. We've looked at where they market, and now we'll focus on how it changes when they market. But I'm getting a little ahead of myself actually here. Just wanted to reiterate the point about why apps are so important. It's really about the triple play in revenue. Now, I'm not just talking here about financial institutions developing apps that they sell to consumers. I think there's clearly an opportunity for that. But more importantly is for the banks and credit unions to become a platform for third-party developers. Remember, these are folks who are struggling to get their apps noticed. And they're very well done, and as you can see, some of them will generate revenues in and of themselves, but they're looking for new ways of distribution, and will look to banks and credit unions as ways to reach their customers, as consumers will increasingly be looking to their trusted providers to help them vet all of these particular apps vendors to understand which ones are best integrated with the financial institutions they do business with, and really become a platform not just for selling in-house developed apps and third-party apps, but to also facilitate in-app purchases for the financial institution's own products, as well as becoming a platform for third-party. And we'll see this a lot when we talk about this third aspect of changing changing when financial institutions do their marketing as a result of changes in the mobile innovation space. Now, if you think about this from a marketing perspective, there have been these moments of opportunity that financial institutions have looked for in terms of reaching their customers and prospects. I'm sure you're very familiar with these moments of opportunities. You know, when one of your customers or prospects, you know, one of your billionaire customers wants to buy a house and you want to be the first one with a 1% mortgage offer. Or what about when one of your customers has a new addition to the family and you want to be there with offers for new savings accounts or 529 plans? Or what about when one of your customers has the need for a new car and there's opportunities for car loans or car insurance? These are the old moments of opportunity that you looked for and are able to reach a customer with a new marketing message to help do more business with that customer. But what's emerging as a result of innovations in mobile technologies is a new moment of opportunity. And for me, this new moment of opportunity is best captured with this picture. It's when one of your customers is walking down the street, sees a pair of shoes that she likes, whips out the smartphone and takes a picture of it. Now, what she's probably doing here is doing nothing more sophisticated than posting this to Instagram and telling her friends that she just saw a really cool pair of shoes. But she might be scanning that QR code. She might be scanning the UPC code on that for that particular product. And, you know, there's really no shortage of applications in the market that can tell her that these are a pair of Jimmy Choo shoes and that they cost $400. Hundreds of apps either out there already or that will be out there that will tell her that information. But what's not out there, and where the big opportunity for financial institutions is in addressing the additional questions that this customer has. Because in addition to wanting to know what this product is and how much it costs, she also wants to know, can I afford it? And that means being able to tap into her accounts, being able to tap into her budgets, her PFM information, and know that if she spends this $400, that she might be blowing her budget out of the water, or maybe she isn't blowing the budget out of the water and that she's absolutely fine in doing it. And if she is, then the second question she has is, well, how should I pay for this? She's got a multiple range of options to pay for, put it on debit cards, credit cards. She wants to know which one's the best one to pay, and can she use rewards points towards this? Pulling that information to help her make a smarter decision is something that Apple and Google and so forth can't do. It's something that the financial institutions are going to step in and do. But she also wants to know, can I get an offer? And that's where the merchant-funded rewards, the daily deals market comes in. She wants to know, is there anybody else out there who is willing to give me a deal on this particular product right now that I've demonstrated some interest in it? And there's a social aspect of it, well, because she wants to know what others have paid for it and what do they think about it. And for financial institutions and card providers in particular to be able to kind of pull the data together to look across the payment stream to see what other consumers have paid for this and better inform her decision is really where a lot of the competition will be focused in the next couple of years. This new moment of opportunity, though, isn't just about retail mobile shopping. It's even when we're talking about mobile shopping for other types of products and services that might be more closely related to the traditional types of banking systems. Commonwealth Bank in Australia has developed an app that lets people take a picture of a building with their smartphone. And what the app does is access real estate databases to let this person know, is this particular building for sale? And if it is, what are the prices? What are the details about this home? Have offers been made? And allows the app to track the locations that the consumer has looked for. You think about the importance of this from a financial institution perspective. It is allowing the financial institution the ability to get into the decision process for this customer who will ultimately need a mortgage, ultimately need home insurance, but it allows them to get into that decision process way earlier than they were ever able to get into that process before. It used to have to wait until maybe the realtor provided a referral to the bank or credit union or mortgage provider. Or perhaps, you sent out some sort of piece of direct mail and took a chance that somebody actually was interested in that you happened to hit them at the right moment. With an app like this, not only is it changing the shopping behavior of the consumer, but it is enabling the financial institution to become more involved in that decision process. And, it's also, when we talk about mobile apps becoming a marketing platform, it's not just the marketing platform for the financial institution, but it's a way for them to generate revenue through non-traditional sources. Folks, there are marketers who kill to identify new movers as early as possible. They used to have to get information from magazines that would tell them about subscription changes, from the U.S. Postal Service when there were notifications of address changes. There's no better clue that somebody is ultimately going to be purchasing a new house than downloading and using an app to help them shop and track information for those homes. So there are marketers who will kill to get closer to that consumer earlier in that decision process and enabling them to do marketing through this type of platform way earlier than they have in the past and generating revenue for the institutions. So how does mobile change financial institutions? Changes what they market to the creation of new accounts, changes what and where they market by using mobile apps as a new marketing platform, and changes the when, what, and where that financial institutions market through mobile shopping. But as I tried to indicate as we started off, that it does a lot more than this. It is creating a new phase of competition in financial services. If we look at this in a bit more historical context, and I'm talking about going back 50, 60 years at this point, the first wave of competition in the industry was really about location. Who had the most branch locations? What was the quality of the service in those branches? There's a lot of discussion these days about the death or the lifespan of branches. I would not say that branches are dead by any stretch of the imagination. I think we've got to reinvent their value and purpose and do a better job of marketing that value. But regardless of where you stand in that argument, I would assert that the importance of branch location has diminished over time in terms of how consumers decide who they do business with and what products they choose. What has not replaced, but has added to the focus on location as a competitive device is a focus on rates and fees. What happened was we got smarter. We got more educated. The education levels in the U.S., the percentage of consumers who are high school or college graduates has risen dramatically since 1950, 1960. And as a result, we've become, or believe that we'd like to become, a lot more rational decision makers. We don't believe that we should be making decisions on fluffy things like who has the best colors or best logos. We want to make decisions over who has the best rates and fees. And financial institutions have picked up the ball on that and have really focused since the mid-1970s or so in focusing on competing on the basis of rates and fees as well. But what's happening now is a new wave of competition is emerging. In an environment where it's awfully difficult to differentiate yourself based on rates and fees because fees have become so highly regulated, and in an environment where the interest rates are so low, the ability to differentiate on the rates becomes difficult. It's creating a need to compete on a new basis, and I think that new basis is in performance. How well does a financial institution help its customers manage their financial lives from a performance perspective? And what this is creating is a need for financial institutions to create something that I would think of as the total benefits of ownership statement. You know, if you're an IT guy, you probably understand the concept of total cost of ownership. The idea that the cost of a particular piece of software goes well beyond the sticker price because there's ongoing maintenance and enhancement. From a consumer perspective in financial services, the concept isn't just about the cost of the ownership of a product. It's about the benefits that they get out of it. And there's really sort of like an income statement that's involved here. Now there are monthly fees and penalties and service fees that are generated in owning a particular account. But for the most part, consumers really only see the first part of it, monthly fees, when they're making a decision. The penalties and service fees are based on their ongoing behavior that they often have very little insight into, and that financial institutions aren't doing a particularly good job of helping them understand either. On the other side of the coin are the benefits that they generate from these accounts. And it's clearly easy to publish and harp on what your interest rate is, but with interest rates so low, the benefits that consumers are generating from these traditional type of products doesn't really outweigh the costs. And so what we need is to do a better job of tracking the rewards that are redeemed, the offers that are accepted, the savings that are generated, not in savings accounts, but savings from making smarter decisions as a result of using PFM tools or deals. Let me give you an example of this. I'm a Bank of America customer. I've got a Bank of America debit card. Bank of America has a program called Museums on Us, I think it's called, where once a month, the first weekend of the month, they offer free museum admission to a whole host of museums across the country. About a month or so ago, my wife and I went to the Museum of Fine Arts here in the Boston area, flashed our B of A debit cards, and got in for free and saved $50. Now, if we had an account that had a $5 monthly account fee associated with it, that's $60 a year, and the $50 that we saved on that one day by taking advantage of that program would have wiped out 5/6 of the cost that we would spend on that particular account. But nowhere is that bank, and I'm not just picking on B of A because I don't think any financial institution in this country is doing a good job of tracking this stuff, is tracking that I took advantage of this, saved $50, and put it on my income statement as a means of showing me the total benefits of ownership. Remember the example I showed you with the insurance company and the telematics? That's what insurance companies are able to do using mobile devices. They're using that telematics device to not just change the nature of the product, but to provide better information back to the customers about their driving performance and how their driving performance impacts what they spend on insurance. So here's a screenshot from a mobile app from one of the insurance companies that shows that based on the information that's gathered through the telematics device, this particular customer only grades a B on braking. That's probably my wife or daughter's. A- in mileage, B+ in terms of the time of day that they travel, and are doing a pretty good job in getting an A in terms of the speed. What that means to them, and to that particular customer, is that the current discount that they're getting, that was the promised rate, is 10%. But based on their driving performance, they're looking at a projected discount of 18%. And what this enables the financial institution to do, in this case the insurance company, is does a couple of things. It better engages this customer, it changes behavior, and demonstrates that the tools and capabilities that they're providing is impacting the financial performance of that particular customer. And this is the new basis of competition, is competing on how well do we help consumers, how well do financial institutions help consumers perform. It's changing not just the nature of competition, but changing marketing. It's changing the skills and the competencies from a focus on gathering demographic data to gathering behavioral data, and changing the core skill of marketing away from coming up with creative stuff to really requiring a new skill in analytics. But for me, I think one of the most fundamental changes in what we'll see from a marketing perspective as a result of these changes in technology is a change in the philosophy of marketing, away from a focus on persuading customers to a focus on engaging customers as a way of deepening the relationship. These changes create new challenges for financial institutions. Clearly, the level of analytics capabilities, especially from a marketing analytics perspective, needs to be raised to a large extent. But there are a couple of barriers and obstacles that are getting in the way of a financial institution's ability to meet the challenges of this new environment. And for me, as I talk to a lot of financial institutions, there are two that particularly come up time and time again, and it's the ability to integrate customer data and the ability to integrate applications. So this is how mobile will impact the future of retail banking, by creating a new phase of competition in financial services. And what I'm going to do at this point is transition over to John and let him talk a little bit about how financial institutions will meet some of these challenges. John, the floor is yours.
Thank you, Ron. You've certainly given us a lot of great ideas to think about, and in particular, based on my driving behavior, how I would never give my insurance company access to that information. But with the perspective of mobile as the new opportunity, and how financial institutions begin to differentiate their brands using mobile as a key driver, one of the questions we have to ask ourselves is what kinds of challenges we will face or may face today, and how we take advantage of mobile as that new opportunity. You mentioned the what, where, and when of consumer interaction and exchange in their consumption of financial services, but how do we as bankers look at both our internal challenges and external challenges, and what do we do to move towards taking advantage of that mobile opportunity? If you're a first or second generation mobile financial institution who has a mobile platform out there today, some of the internal challenges that you may be facing are management of multiple platforms to manage each individual channel, your desktop and your mobile channel. That could potentially create an inconsistent user experience. And those are some internal challenges that institutions may be facing, but those also may translate into some external challenges. One of the things that I think that we definitely saw you illustrate in your conversation, Ron, was how technology has changed and how that's changing the consumer experience. We've got a constant evolution of smartphones in today's world. Consumers are constantly adding new phones, and the requirements for those devices are ever evolving. And what that presents is a difficulty to keep up with those changes in technology. But does that enable or does that limit the ability of an institution to differentiate their brand, and does it hamper acquisition and retention targets? So how do we address some of these challenges when we talked about the return on equity and non-interest income? Well, I guess the first simple question, and probably why everybody's listening today, is we all believe that a good mobile banking strategy matters. In the early days of bill pay adoption, either through your own direct results at your own institution or anecdotally through analyst or other studies, we've seen that bill pay has driven things like profitability and lowered attrition when added to online banking. Is that true for mobile banking? And recent studies that we've seen seem to indicate that yes. When you add online banking and you add mobile to online banking, those customers are more profitable and they are stickier. But beyond the profitability and stickiness of those customers, how do you enable the customer's channel of preference to support a lower cost to serve? What does that mean, and how do you achieve some of those ROE and non-interest income metrics? Well, how do you bridge that gap? And one possible way to address the bridging the gap between cost reduction and pricing and growth and delivering on new opportunities is to look at platform convergence. If you've got multiple platforms that are supporting your digital channels, so you've got a platform for your online banking or desktop banking, you've got a platform for mobile banking, those can be inefficient ways to manage a comprehensive digital channel consumer experience. By combining those platforms into a single platform, you gain efficiencies with faster implementation, easier administration and configuration through self-service tools. But what it does, it lowers your total cost of ownership. But a large part of Ron's conversation was around, well, how do we meet the need for next generation consumer experience, the next generation user experience? What is it that consumers are asking for? When my wife shops for Jimmy Choo shoes, I'd like to think that she's thinking about our budget when she's purchasing, making a major purchase decision like that. One way to address that is to differentiate not only desktop banking features from basic bill payment and balance checking and transactional history and account-to-account transfers, but to enable that real-time decision-making with tools like PFM, and being able to manage a user's profile, giving the consumer the point of reference at their point of need. It also enables the targeted marketing of unique products to specific mobile users rather than just the overall mobile base. So being able to deliver a unique, or what Ron referred to as a neo checking account through targeted marketing activities specific to the mobile user really has the capability to differentiate your brand. But beyond that, and I think what we saw comprehensively through the last 45 minutes was we don't know what those next generation of services are going to look like. What's important is to understand that they will evolve, and the user experience and the demand for those features will evolve, and it's up to us as bankers and marketers to understand that and look for mobile or digital banking capabilities that can enable and deliver those next generation services. So what are those next generation services? Well, I think everybody clearly has the perspective that mobile banking started out very simple with text banking, SMS text banking, and has grown, and as we discovered, really the opportunity beyond just serving the needs of the consumer today is going to be through the downloadable application and certainly through a fully integrated browser enabling both the desktop and mobile solutions. But is mobile first, as Ron indicated, is mobile first design really the way to go? Well, certainly I think that's going to enable, from a downloadable application perspective, enable you to reach consumers through smartphone features that they're demanding. As a smartphone user, I want to be able to leverage my geolocation mapping for giving me directions to the local Starbucks when I'm out of town. But I also want to be able to get cash out of my local ATM, so I need to be able to find my local ATM or branch locator. I'm that Jimmy Choo shoe buyer at the local retailer, and I want to be able to understand, hey, do I have the money to buy that PFM? And beyond that, not only is it giving the consumer the opportunity to utilize hardware that's on their phone for information that's relevant at their point of need, but it also gives your financial institution the ability to leverage operational efficiencies from having a consumer complete self-service transactions. So one of those ways is through integrated and remote deposit capture utilizing smartphone hardware. I have seen studies. I'm sure the folks on the call have their own perspective of how much that teller transaction actually costs you just for a simple check deposit. But I've seen anywhere from $3 to $4 per transaction. So the cost efficiency of moving that routine teller check transaction deposit to a completely self-service channel is to some degree a game changer, and particularly being able to deliver that for both consumer and business segments. So you're enabling the consumer to deliver or manage their relationship with your institution the way they want to manage it. And then beyond that, as we deliver marketing opportunities and deliver new products to market specifically designed for the mobile consumer, how do we as financial institutions develop our brand? The idea was brought up that there are inadequacies of marketing in what is a fantastic opportunity in the App Store. Delivering a downloadable app with your brand that consumers can search for that enables them to leverage smartphone features that are in demand gives us a new opportunity to market our institutions in a way that we haven't seen before. The other component of that downloadable application is the in-session marketing. Hey, I've downloaded a free app. What other kinds of services do you have for me? And being able to target uniquely that mobile consumer with specific offers designed for that mobile consumer in the downloadable app in session, so that they've got so we have a new avenue to market our products and services. And then beyond that, beyond the sales component is that final service component. It's the operational efficiency of enabling things like consumers to manage their own profile and control their rights that enable institutions to really maximize their investment, leverage a self-service channel, expand their marketing opportunities into new areas, and meet consumer demand. And that is it for me. So at this point, do we want to move on to questions and answers?
Yes, John, can you hear me?
Yes.
Okay. We just have a few minutes here, so I think we have time for just one question here before we wrap up for the hour. If you have questions, you may still submit them in the QA portion at the bottom right hand of your screen, and if we do not get to them today, we will follow up with you. So we have time for one question. So we'll take a question here for Ron. Ron, how does the topic of big data relate to the impact that mobile is having on financial services?
Well, it probably deserves a 10-second description of what we're going to talk about when we use the term big data. I think part of the problem in the discussion in the world of marketing in particular these days is that it seems like every effort that involves analytics or data has become an example of big data, regardless of whether it's big or little, and now people are trying to call things little data versus big data. I don't know that that's particularly helpful. I think the difference in what is the new capability that consumers need is what I alluded to towards the end of my section, was that the focus is expanding beyond just having demographic data or credit data, but to have behavioral data. And the important aspect of that is not just about being able to predict what somebody does. I actually think that our ability to predict product need is not particular rocket science. You understand, if you know where people are in their life stage and in their life cycle, understanding that somebody might need to be saving for college education or saving for retirement is not exactly rocket science. But what is more difficult is in understanding exactly when to interact with those consumers, where to interact with those consumers and prospects, and to understand which one's most effective, and also from a marketing perspective, being able to look at your actions and investments after you've done them to determine from an attribution perspective which ones were most effective and those that were less effective. So the ability to kind of track and utilize new types of data. And I think what the big impact of mobile is that the mobile device, because it's with somebody all the time, because it's so heavily utilized for such a wide range of activities and a wider range of activities, is that a lot of that behavioral data is being captured and through the mobile device, placing a huge challenge on pretty much every firm across a lot of industries, not just financial institutions, to figure out and make sense, well, how do they use that information, not just for prediction purposes, but for communication decisions, pricing decisions, segmentation decisions. The challenge from the big data perspective is in understanding what are the various ways that this new data is going to be put to use across a spectrum of marketing activities and also product service and customer service delivery. I'm just very focused on the marketing aspect of it because given the nature of my research, but the opportunity to kind of apply that data across a wide range of operations and functions is, I think, one of the big challenges for financial institutions because the mobile device is now helping to generate and create this new ream of data.
Great. Thank you, Ron. And with that, we'll wrap up this afternoon. Thank you all for joining this afternoon, and thank you to Ron Sheblin and John Belos for their presentations. We hope you found the session informative. Today's session has been recorded, so we will send a follow-up so you may access the recording. And we're also happy to share the slide deck upon your request. Please take a moment to complete the post-event survey that will pop up on your screen as you exit the webinar. This now concludes the session. Have a wonderful day, everyone.